In our latest investor presentation, we'll cover the booming Irish economy, the good health of the public finances, but we'll also address the mounting risks beyond the next 12 months. First point is that the Irish economy is in very, very good shape. Recent data showed that modified domestic demand, our favourite indicator, has increased by about 4% last year. That followed growth of 6%, 7% and 5% in the 3 years respectively from 2014 onwards. The boom in the economy is far short of the mid-2000s, if not a lot more sustainable, as it is financed by incomes rather than credit. Consumer spending increased by 2% last year, a little short of the 3% the previous year. But if one statistic sums up the incredible progress that Ireland has made, it's that the unemployment rate in February fell to as low as 6%. That is down an extraordinary 10 percentage points in the space of just 6 years. Second, the Irish public finances are rock solid. In fact, the deficit for 2017 probably fell below €1 billion. But that hides the fact that if you exclude interest payments, Ireland's actually running a surplus of about €5 billion. And here the news is good too, because our interest bill this year will almost certainly fall below €6 billion, down some €2 billion from the peak. Government debt has stabilised at a level of about €200 billion, which is 4 times what we saw pre-crisis. But that's down from the peak of about €220 billion. And this year the news is good, albeit it's very early in the year. So far, it's fair to say revenue is on track and there have been no negative surprises. So the immediate future is promising for the Irish economy, but forecasting is perilous beyond a 12-month horizon. There are 3 sets of risks which I will explore. The first relates to the US, which is our most important trading partner. The fact is it's entering late cycle and monetary policy is tightening. Second, of course, is Brexit. And the third relates to our economic model, where the multinational sector is more important to us than ever before, particularly the technology sector. The US is now late into its economic cycle. If it were a football match, it would probably be deep into the second half. And the Federal Reserve is a little bit behind, probably at half-time in its rate rising cycle. It's probably fair to say that the Fed has been blamed for increasing rates a bit too far and causing the recessions that we've seen since the oil crisis of the 1970s. So it's possible the same thing will repeat this time. Perhaps with a downturn in the US as early as next year, but more likely in 2020 if it were to happen. Now on Brexit, which hasn't gone away. It's good news, of course, that that transition deal has been, in a sense, put on the table, although not quite yet sealed. But data for 17 showed a taste of what we might expect if ultimately there is either a poor trade deal between Britain and the EU or no deal at all. We saw tourist numbers from the UK fall by 5% last year, which was in stark contrast to the significant 10% increase in all other visitors to Ireland. It's probably the case that the weakness of sterling and perhaps some reduction in UK income growth was to blame. If we look at goods exports overall, stripping out the pharmaceutical sector, which is related to the multinationals, exports were flat to Britain also in 2017. On our model, Ireland is more reliant on the multinational sector than ever before, something that we previously flagged. The noise has increased over the last 6 months. Of course, we had the US tax changes before Christmas. There has been a lot of debate about how to tax businesses across Europe. And there's always a risk that something could go awry with one of the business models of the very large companies based in Ireland. To sum up, Ireland has reached full employment and the economy is flying. But there are real threats out there, so there's no room for complacency.